Good evening and welcome to the Smart Entrepreneurship Decoded show. Tonight, we have a different kind of guest. So far, we have met entrepreneurs, we have met venture capitalists, we have met investors, we have met lawyers, different people from different sides of the entrepreneurship space, giving you practical insights, that one small nugget that will accelerate your path to what you define as success for you. No gyan, no nonsense, practical, straight to the point. Our guest tonight, Pranam Shetty, will help us decode what a family office is. And of course, he's more than a family office. He runs other funding firms. He's had an illustrious career. He comes from one of the top management schools of the world. We'll try to understand from him how he looks at the scene today. Not just from funding, because funding is overvalued. Most people in India, I'm surprised, think funding is a birthright, but from the age group I come from, even entrepreneurship was looked down upon. I would get a tight slap from my father if I said I wanted to be an entrepreneur instead of an engineer and doctor. For him, me becoming a chartered accountant was a huge climb down in society. But today, entrepreneurship is socially not only accepted, but celebrated. And most entrepreneurs actually need advice, not funds, but they think funding is a birthright. So let's welcome Pranam Shetty tonight and talk to him and see what his views are on some of these aspects. Welcome, Pranam.
Thank you so much, Nalin. I hope to live up to your description of myself, and it's really an honor to be chatting with you. I'm an admirer of how you steer these conversations and look forward to having a meaningful conversation today.
Thank you. Actually, I was speaking to you before the show and I was telling you that I like the way you approach deals, right? I have watched you at India Fund Fest, and there are investors of all kinds. There's no right or wrong. Everybody has their philosophy, everybody has their way, everybody looks at things their own way. But your way is quite aligned to mine, which says, I may be wrong, but I'm not confused. This is my comfort zone. This is my investment philosophy. This is the way I engage with an entrepreneur. Either you're on or you're off. And you have a very hands-on approach to that, and I love that. But before we get into that, entrepreneurs hear about HNI, high net worth individuals. They hear about angel investors. They hear about VCs, PE funds, SPACs, all of that. But a newer phenomena, especially for India, which has caught on quite a bit, because now I hear there are 800 of them, is what is called a family office.
Right.
What is a family office? Talk us through that.
Absolutely. I mean, at the end of the day, it's an investment management vehicle.
Okay.
And it can come in several different forms. But typically it gets established by traditional business houses, newer entrepreneurs, new age entrepreneurs who've had an exit, or celebrities who manage their own wealth. They appoint someone to steward their wealth, or they invest themselves. So it's a way to aggregate your assets, to allocate capital, manage your portfolio, and then hopefully pass that to the next generation in an efficient manner. So of course, there are several legal structures that can let you manage the family office better. We've sort of stuck with a very simple structure. We have a loose syndicate of holding companies that allow us to deploy capital as and when liquidity is available in any of these structures. And that's how we operate. Few other family offices may operate a little differently, but I'm happy to take questions on that.
So these are not like alternate investment funds or something. These are more like LLP kind of structures, are they?
Yeah, they could be AIFs, and a lot of family offices have gone down that path. In our case, because we had legacy businesses, especially in the financial services and real estate domains, it was simpler for us to continue investing from those holding companies, right? There was a reserve of cash available, and it was easier to deploy through those entities. A lot of others tend to restructure their family office in terms of either a trust or an AIF. And you can go either ways, depending on what you intend to do with that capital, right? Like if you have to split up that capital between different factions in your family, then you may prefer one structure over the other.
Okay.
But of course, if you're looking to pass on generational wealth in an efficient manner, probably an AIF or a trust structure might work best for you.
So
Um,
an AI
yeah.
for a family office typically brings in a professional manager to run it, right? But is it all about startups, or do they have a diversified portfolio? I mean, do they have other aspects to the family office?
The answer would depend from family office to family office, but most family office tend to have a very diversified portfolio.
Okay.
In our case, for example, because of our legacy involvement in financial services and public equities markets, our original portfolio skewed heavily towards traditional asset classes,
Okay.
bonds, other fixed income products, real estate, public equities. But lately, we've diversified into alternative asset classes as well. We haven't gone to the extent of investing in Bitcoins and other cryptocurrencies yet, but these are all ways and means of diversifying your portfolio. There's derivatives, of course. And depending on the risk appetite of the family office and the needs of the family, the liquidity requirements over a period of time, that asset allocation may vary over a period of time.
So, now, of course, there are varied numbers. The last number I read was there are 800 odd family offices in India. It probably is much more.
Right.
Because many things in India are underreported in such aspects.
Right.
But in your experience, I'm not asking about your family office. That's all confidential information. But in your experience, what percentage do you think family offices generally look at startups? Is it 10, 20, 30? I mean, what is that kind of average that they would look at unlisted startup investments?
I think things started changing in the last 5 to 10 years, right? Probably family offices as a phenomenon itself was not necessarily, not necessarily something that people pursued. It was a Western concept. When it came to India, it was typically the traditional structures, much like ours, that deployed capital. And we've been doing this for 20 odd years. But lately, with the amount of exits and the transaction volumes that you're seeing in the early stage space, every family office worth their salt is now allocating capital to that asset class. That number may vary. Some family offices may allocate a smaller percentage and others a higher percentage, depending on their risk appetite. But it's definitely being seen as a high growth avenue for family offices to deploy excess capital. And typically, all of these family offices have some cash cow, right? They already have an entity that's able to generate cash for them. And so a portion of that risk capital, that excess reserve, can be allocated towards startups. And this can range from anywhere from 5% to 10 to 20% in some cases.
Is it still largely real estate heavy?
I would think so. I mean, especially if you look at the more legacy family offices, very heavily skewed towards both commercial and residential real estate and other derivatives of underlying real estate assets. And more lately, the newer age entrepreneurs who've had their exit through the startup ecosystem, of course, they love to plow their returns back into the startup ecosystem. It's a way of also paying it forward, but also a way for them to kind of use their own expertise and mentor the entrepreneurs further. So you'll see a lot of companies like Paytm and their founders, so even for now, other startup founders who've had an exit or a meaningful exit, setting up their own family offices, Titan Capital, for example, or VSS Holdco. They do a lot of investing primarily in startups, and then they look at other traditional asset classes to diversify. Other family offices have approached it the other way, where they've had a more diversified portfolio and they look at startups as a way to diversify further and possibly have a higher rate of return on their invested capital.
So knowing you are a lot more than a family office. You have other investment interests as well as firms.
Yeah.
Forget the firm's philosophy for a moment.
Yeah.
Now, as an individual, you are constantly bombarded with proposals. Everybody has an idea and everybody thinks funding is a birthright.
Yeah.
What is, when you meet somebody for the first time who's pitching to you with all their enthusiasm, etc., what is it that you look for as a first filter?
Right. Honestly, there is always a framework sitting at the back end, right? You want to be able to check off those boxes. And typically these are heuristics or rules of thumb. And there are a few that we rely on. But essentially it boils down to a combination of intellect, intensity, and integrity, right? Like this is what you're looking for. And And the people who've made it big in the investment world, the likes of Buffett and Soros, they've all followed a similar framework of the kind of people they like to back. And Buffett often says this, that if you back people with intellect and intensity, but not integrity, then you're probably backing the wrong kind of people, right? They're going to cause a lot of trouble. So intellect in its variety of forms, right? You want people to have that emotional intelligence to lead their team the right way, the ability to connect the dots of their past experience and to bring unique insights into the industry that they're exploring, intensity to be able to be persistent, resilient in the times of hardships, to be able to steer the company in the right direction, and the integrity to do things the right way, right? As an investor who's looking from the company from the outside, you want someone who's going to uphold the interest of the minority shareholders as well as their partners. And so that integrity piece, unless it's clearly visible in their past track record, we try to steer away. I mean, you don't want to be, having nightmares or thoughts about how your money is going to be managed, especially in these cases. And so you want to be able to partner with someone that you are comfortable with, that you have that rapport with, and that's great, especially important for us. So nothing too complicated. We keep it simple. We do have a framework, a matrix that we follow, but it's very straightforward rules of thumb.
It's actually very well said. Intensity, every entrepreneur comes and tries to show as much as they've got.
Yeah.
Intellect is a matter of judgment, especially the filter. And integrity in India and a lot of other countries, especially India, where jugaad has become a fashion, gets a bit fuzzy.
Yeah.
That jugaad is useful to a point. Beyond that point, when it gets larger and governance comes into picture, it becomes a liability.
Yeah, absolutely. And for us, integrity just means, are you following through on what you're committing, right? Of course, we want to avoid that there is that extreme that's going to, be involved in fraud and other malevolent activities. But I'm not even talking of that. I mean, to me, integrity simply means, do you follow through on what you said you will do, right? Are you being honest to yourself and to your people? And if that's very clear in your past history and your track record, then probably we have a good chance of getting along well together.
It's one of the things I tell entrepreneurs all the time, that if you are eligible for funding, the only thing that will get you funded is credibility.
Yeah.
If you have credibility of some form, knowledge, experience, and you say what you do and do what you say, you have a higher chance than anything else. Everything else you read may or may not happen. You want to go down that 1% luck factor, up to you. So it's interesting. You put it more eloquently than I do. I'm a little more brusque and blunt about it. That was nice.
It also helps that we don't, our investment cycle tends to be a little longer, like our due diligence tends to be more disciplined. And so we are able to observe the entrepreneur over a host of point of interaction. So we are able to see a curve of what has been represented at one point versus another point. And that allows us to judge the character of the person a little better, hopefully, than a lot of the other angel investors. We're okay waiting to invest at a higher valuation than going in when the optionality is greater, but the data is a lot more fuzzy.
It's true. The average exit in a startup, even successful or not, is a different issue, is 9 years.
Yeah.
And in today's world, that's longer than marriages last. You do need to have the right chemistry, and you do observe the entrepreneur for a much longer time than what is, what entrepreneurs like to believe. Especially the ones who are not as knowledgeable.
Absolutely.
So let's take it a little further. Now, investors or people who run investment funds or are investment managers like yourself tend to come with a certain degree of knowledge and from certain kinds of institutions. Now in the US, 66% of VCs come from Ivy League colleges.
Yeah.
Even in India, we have the IIT, IIM clubs, etc., etc. When you look at startups, and the typical startup guy, especially in countries like ours, unless they are networked through those colleges, tend to be jugaad guys, who are not as sophisticated and all that. Is there a chance that there's a communication gap or a cultural gap or a miss? Because this tier 2, tier 3 town people, they have all the right ingredients, without a doubt.
That's true. Yeah.
The two big companies of India, Ambani and Adani, they were not exactly Mumbai born, etc. Right? But today they are considered that way. But this is where the future of the wealth creators lies. This is where they come from. Do you think people like us misjudge them sometimes, or we miss opportunities because we can't relate to them?
That's a very interesting question. And I would have to admit that I would be guilty of those biases as well, right? Like the principle of likability, right? Because you're looking for two things. You're looking for people who align with your value systems and your cultural mores. And you're also looking for people who have some shared interests or life experiences. So unfortunately, because of that bias of likability of people like you, I guess a lot of us would tend to steer away from the kind of people you're talking about. They may come with the right kind of business jobs, but may not have the right sophistication to be able to communicate their thoughts very articulately, or to be able to be put directly in front of an esteemed panel of investors right off the bat without some training. So yes, those biases do creep in. And I guess I am as guilty as anyone else.
No, I've had people who come and I'm used to Excel sheets and looking at data in a particular way because I've educated that way, or I have coached myself that way.
Yeah.
And this guy walks in and he doesn't speak English as well. He's not as articulate as you say, but he's running a cash positive business. Yeah. And sometimes if you close your eyes and think, if this guy was from IIT IIM and walked in with a suit and tie, would I look at him? If he was introduced by a consultant who was known to me, would I look at him differently? And sometimes I think these guys kind of lose out. I say that because I held a Northeast India Fund Fest in Guwahati last February. And the ideas and the companies was pure outstanding.
Yeah.
But sometimes the investors felt, what is your total addressable market? And they looked at the Northeast.
Yeah.
But hey, Northeast put together, the population is more than 80% of the countries. They don't have populations as much, right?
True.
It's a wrong comparison. So sometimes I think we miss out, and that's what I was trying to scrape through.
I absolutely agree. I mean, there is that likelihood of missing out on these diamonds in the rough, simply because you're trapped in your own biases. And it requires an exceptional level of clarity of thought and an ability to introspect on what really matters in that particular business or that particular industry. Like, do you need the suits to be able to sell product in this industry? Or do you need the people who can actually, jugaad their way through it, so to speak? And if you have the ability to identify that, perhaps that's one level of empowerment for yourself to be able to identify those right entrepreneurs to back. I think, what I'm talking about is the right fit of product with the founder or the market with the founder. And if you're able to find that, irrespective of their background, whether it signals the right kind of pedigree or not, I think one should have the ability to back these entrepreneurs.
So let's, for a moment, get to today's world, post-pandemic, not post-pandemic, in pandemic, because this will last for the next 3 to 5 years in phases. But what are the sectors that are exciting you right now? Because there's a deluge of funds, right? The US bond buying, etc. It's just flush with liquidity. So what is it that is catching your attention right now?
Well, what is catching my attention is the sheer amount of digital transformation that's happening across industries. Mm-hmm. And simply put, I want to be able to invest in companies that are enabling that digital transformation and that can have that horizontal play in a specific industry. So, for example, one of the companies we invested in the recent past, they digitized the entire insurance broking industry. Now, as you know, in the insurance world, there are a lot of D2C companies that have come up, and they've, of course, raised a huge war chest from significant VCs. And here comes along a company that says, hey, wait, I have a counterintuitive approach. Here is a $100 billion industry of insurance broking that is being threatened by these D2C companies. How can we make them more future ready? how can we transform that industry and give them the right kind of toolkit to be able to contend with these D2C players, right? And so a lot of such digital transformation is happening across the spectrum. And we want to be able to identify these enablers, whether it's in insurance, whether it's in payments, whether it's in e-commerce, social commerce, and we want to be able to back them. Have we found the right kind of company yet? Probably not, but the thesis is already in place. Very similarly, we're looking at media and entertainment and how AI is actually shaping consumer choices in consuming content and being able to become owners and creators of that content. Have we been able to figure out the right kind of business models that would go with these new customer trends? Probably not yet, but I think we're getting there and we're tracking those trends to see if our investment thesis and these trends can somehow find an overlap with the right kind of business model. So these are two, I would say, that are particularly exciting for us. A company in that space that we found very interesting was a company based out of Bangalore that creates phygital toys. So they essentially transform the physical play element of a child's experience into a phygital experience where they can play with the toy, but also interact with the screen. So it's, these are all companies that essentially have clients that are really looking for some kind of transformational experience. They're already educated and coached how to go online and use online interfaces, but they're waiting for that transformation. Whether enterprise or consumer doesn't really matter to us. We are agnostic, but they're waiting for that transformation to get to them and for them to be facilitated with a whole new set of experiences. And so those are the things that we're excited by.
That digital toy business is quite exciting. You must connect with me on that if they ever want to come to Indonesia, because it's very, very interesting.
Yeah.
Another topic I want to touch upon, startup funding in India is new, right? 10 years, 15 years max, early stage funding and all that. It has been more mature in the US, Europe, etc.
Yeah.
A lot of the funds are US, Europe based. And now, of course, China is coming up and India will also come up, etc. Do you see a fundamental difference in which an Indian fund looks at the opportunity versus a foreign fund? It's not just about the size of investment, but just look at it. Do you see a difference there?
I guess the difference is in the expectation of returns, right? I mean, especially these foreign funds which are raising dollar-denominated capital, the expectation of return in their markets perhaps would be a lot different than when they look at maybe an Indian or an Indonesia, because these are emerging markets.
What is it? So, is it a more patient return they expect or what? Is it patient capital or impatient capital?
It would depend from fund to fund. I mean, I would not want to...
Your experience.
Yeah, my experience has been that they're looking at deploying capital with the intent of returning capital maybe in 7 to 10 years. Okay. And unfortunately, while in the Western world, that would be true. A lot of these businesses would be, because the infrastructure is already in place, right? Like if you look at India, the e-commerce, the logistics, the payments infrastructure is still just falling in place. And on top of that, you're having these D2C brands getting enabled. In the US, that was the case 10 years ago. And so you could pump in money into a D2C brand and see them expand to a $100 million business in 5 to 7 years. In India, that's going to take a lot more longer. You're seeing the example of companies that are getting listed and they've still not hit that mark, right? Like some of them are still not cash positive. They've IPO'd, but they're still burning through hundreds of crores of investor money in the hope that in the future, some vertical that they build does generate positive cash flow. And that's not happened yet. And so I do feel like there is that difference in timelines. I think an Indian investor tends, especially an institutional investor, understands how tough it is to build a business in India. And the timelines there tend to be a little longer. You're talking 10 years plus. Whereas some of the foreign funds, they come in and they look for 7 to 10 year exits. And sometimes that's not always possible.
Coming to the entrepreneur side of it, do you feel sometimes, in India, now each one of our cities has got a population and market size larger than 80% of the countries of the world, right? Do you think entrepreneurs try to shoot for too much when they say, I will go national or statewide? Global is another thing altogether. But rather than dominate one scaling unit like the city or the neighborhood, For example, I ask many entrepreneurs, how come you have 3,000 Facebook friends but only 100 customers? Things like that.
Yeah.
Do you think they're shooting for too much when they talk national, etc.? I mean, they don't know what they're talking about.
I think there is an interesting paradox there, because of course you want them to be highly ambitious and you want them to create a vision that can scale across state and national borders in the future. But at the same time, you want them to have that hyper focus, especially at the early stage, to be able to prove out their early hypothesis on either the product or the market, and then slowly expand into adjacent markets from there, right? I guess it's because of the ease of availability of capital today that these ambitions can catch that fire. I mean, it just adds fuel to that fire, right? That kind of creates a sort of misalignment of incentives between the entrepreneur and the investor, because the entrepreneur is always looking for more capital because of greater and escalating ambitions. But the investor sometimes is looking for either growth or profitability, depending on the kind of the investor. And that's why you need the right fit of entrepreneur and investor, depending on the ambition. There is this interesting rule of 40, right? Like if you want your growth rate to be 40, then you have to expect your profit to be below 0. So depending on what kind of growth or profitability levers you want to pull, perhaps that ambition may be justified, perhaps not. But for certain, you want them to be hyper-focused in those early stages, at least until they achieve product market fit. After that, hyperscaling is definitely a possibility. You just need the right kind of investor to back you.
Very often, entrepreneurs don't understand that the investors or the funds are under more pressure to find the right entrepreneur than they are to find the right investor.
Oh, very true. Yeah.
So, okay. I'm going to come to my last question, and it's got nothing to do with work. Most entrepreneurs feel that or believe that success in life for them means getting rich and having a lot of money, etc., etc., etc.
Yeah.
Now, for fund managers who are dealing with money every day, doesn't mean you are necessarily rich yourself, but you're dealing in money every day, but you're perceived to be rich.
Yeah.
What is success for you? What do you think as I will be successful when I get to this?
I think for me, it's about financial independence at the end of the day. And financial independence, honestly, has nothing to do with money, right? It's about the independence you have with your time. There are 3 things that I would never risk in the pursuit of financial independence. One is my family, one is my freedom, and one is my reputation. And outside of that, if I can achieve financial independence, which is to me, the ability to allocate my time however I choose fit, whether I want to allocate time to my family, whether I want to allocate time to my business, or whether I want to allocate time to social or my friend circle, I should have that freedom. That to me is success. The day I'm able to say that I have achieved that position in my career, I would think I'm successful. I don't necessarily quantify it with a numerical value. I prefer to think of it as how am I able to utilize my time on a day-to-day basis in a manner that I see fit. And if on a daily basis, I'm able to wake up and feel excited about going to work, then I think that's a perfect marriage of work-life balance, and that's success too.
Such a non-millennial and non-sexy answer, but it's a true answer. I truly believe those are the values you should live for. Money is a commodity. It will come and go. Everything else will last. And you said right boxes, family, reputation, things like that are what you live for. Everything else will come and go.
Yeah.
Pranam, it's been an absolute pleasure having you.
Thank you for having me.
Very insightful and very candid answers. I couldn't have asked for more. Thank you very much, and have a great evening today.
Thank you, Nalin. Thanks for having such insightful questions and making me reflect on some of my thought processes. It's been a pleasure. Thank you. Take care.